Hello everyone. In this session, we'll be learning about the basics of bonds and some calculations that we'll be doing using the financial calculator. So as all of you know, bond is a form of debt under which the company or the government is able to raise money in order to finance its operations. So as we can see the example over here, XYZ Incorporation, they are issuing bonds with a face value of $1,000, 5-year maturity, and a 6% coupon rate, which is paid annually. Now, the 6% coupon is the 6% interest that the company is going to pay. So you are buying the bond today from the company for $980. This is a very plain, vanilla, simple kind of an instrument without any complexities. So it's a form of debt under which the borrower, the issuer, the company or the government is borrowing certain amount of money today, and the company is agreeing to pay periodic interest during the tenure. So this is a 5-year bond. The company will pay you interest every year for the next 5 years. And upon maturity, the company or the government agrees to pay back the principal amount to the lender or the investor. So me and you, if we buy the bonds, we are the lender or the investor. So from this particular example, we are able to understand certain terms. So the issue price or the present value or the current market price is 980. This is the price at which we are purchasing the bond. The number of coupons or the number of interest payments that you are going to receive is 5 because it's a 5-year bond and it is paying you interest annually. Now, what is the amount of interest that you are getting? Now, interest is also known as the coupon rate. So the interest received is 6%, which is 0.06 multiplied by the face value, 1000. So we are getting the answer as 60. So every year for the next 5 years, the company will give you $60. The face value or the maturity value or the future value, everything is the same in this question. It is $1,000. So today you are going to buy the bond for 980. Then the company is going to give you interest for the next 5 years, which is $60. And after 5 years, the company will give you back the face value, which is $1,000. Now, bonds can be issued at par, premium, or discount. If the present value is equal to the future value or the face value, then we say that the bonds are issued at par. So if, let us say, we change the example, the company is issuing the bonds today and the face value is also 1000 and the present value or the current market price is also 1000, then we say that bonds are issued at par. If the present value is greater than the future value, then we say that bonds are issued at a premium. So $1,000 face value bond, if it is issued today for more than 1000, let us say 1030, then we say that the bonds are issued at premium. In our example, the present value 980 is less than the face value 1000, so our bond is issued at a discount. Now, when or why are the bonds issued at par, premium, or discount? That we'll discuss later in the class. So here is a timeline of the cash flow. Today we are going to invest 980 in this bond. At the end of year 1, T is equal to 1. We are going to receive 60. And at the end of year 2, 3, and 4, and 5, we are going to receive 60. At the end of 5 years, the company is also going to give back us the par value 1000. So T5 cash flow is 1060. Now, if you notice, today we are paying 980 and I have put a minus sign over here. Whenever you are investing money, money is going out of your pocket. So we will always put a minus sign. This $60 continuously and the 1060 at the end, you are receiving this. So we are going to put a plus sign, and plus sign is not required. So we are keeping it as it is. The return that the investor is going to generate by buying the bond today and holding it for some time, it is known as yield. So yield is the return that you are going to generate by buying any particular bond and holding it for some time. If you're buying the bond and holding it till the bond matures, that means if you're buying the above bond and holding it for the entire 5 years, the return that you are generating, the yield that you are generating, it will be known as yield to maturity. So if you're buying this bond and holding it for 3 years, it's a 5-year bond, but you're holding it only for 3 years, the return that you generate is known as yield. But if you are holding a 5-year bond for the entire 5 years, the yield is known as yield to maturity. Both of these are the return, but it totally depends on how long are you holding the bond for. Now, the objective of this particular session is how to calculate this yield to maturity using the financial calculator. The mathematics behind the YTM, this will be discussed in class. So today I am going to show you a shortcut that you can use in order to calculate the return. Now, in order to do the calculation, you have to download this app from the Play Store or from the Apple Store. The top one is from the Google Play Store and the bottom one is from the Apple Store. So download this and then you can proceed with the session. The first step that we are going to do is we are going to set up the calculator. We are going to set the number of decimal places to 6. Now, as you can see on the screen, the number of decimal places is 4. So as you can see this particular calculator, there are some items which are written in yellow. So over here, MEM, format, reset, profit, everything is written in yellow. So in this calculator, if you want to access anything that is written in yellow, you have to use this particular button, which is the 2ND. So if you press this 2ND, you will be able to see 2ND on top. And if this button is pressed, you will be able to access everything which is written in yellows. So first we have to press 2ND and then we have to press format. Format is above this decimal. So let us press that. Now in your screen, it will be showing as DEC is equal to 4. Now DEC refers to the decimal. So there are 4 decimals. Now we have to make it 6. So what you have to do is you just have to press 6, then press enter. And now you are having 6 decimal places. So I've written the steps on the left. So use that steps or rewind and then do this action first. And after pressing enter, we just have to press this CE or C 2 times. So now we are able to see 6 decimal places. So let us solve the first sum. Now XYZ Incorporation is issuing bonds with a face value of $1,000, 5-year maturity and 6% coupon rate is paid annually. You're buying these bonds from the company today for $980. Now this is a plain vanilla bond. We have already seen this. So how much return are we generating from this bond if we buy it today and we are holding it for the entire 5-year duration? So this arrow is pointing out the buttons that we are going to use. So you will be referring to the third row. So first is N. N refers to the number of coupon payments or number of interest payments that you are going to receive. So N is equal to 5 because it is a 5-year bond and we are going to receive 5 coupon payments. Next is I or Y. This refers to the interest or yield and this is what we are trying to find. Now this is the answer or the YTM that we are trying to generate. It is not the coupon rate. The 6% coupon rate is not your I/Y. This is something we calculate towards the end. The next term written over here is the PV. PV is the present value. What is the money that I am paying to purchase this bond today? It is 980. Now because we are buying the bond, money is going out, we have to put a minus sign. So we are going to write it as minus 980. Always put a minus sign as this represents a cash outflow or an investment. Next is the PMT. It is the periodic payment. In our particular scenario, it represents the interest that you are going to receive every year. So it is 6% multiplied by the face value 1000, which is 60. So your PMT is going to be 60. The last is the FV. FV is the future value. It is the amount that we are going to receive upon maturity, which is equal to the face value, and this is going to be $1,000. So these are all the inputs or all the variables that we need in order to calculate the I/Y, which is the second. That is why I've written it with a green color. Now, whenever you get a question, it will always help to write down these values. Then it is easy for you to enter them in the calculator. Once you have practice, you need not write it down. So let's go to the calculation. So now I'll show you how to do the calculation. If you refer to the calculator tab, we enter the values first and then we assign the term. The order is not important. You can enter the data in any order. Only thing is whatever value you need to calculate, that we will get towards the end. So let us start. First, we have to press 5. So enter the values first and then tell the calculator what is this particular value. So I enter 5 and then I'll press N. In your screen, you will see N is equal to 5. So we have entered the first variable. Next, we have to enter 980. 980. We have to put a minus sign. For this, we are going to use this plus minus button below. If you press this, you will see minus 980 on the screen. Do not use the minus sign, the normal minus sign that we do in mathematics. Do not use that. Use the plus minus sign. If you use a minus sign, you will see the minus after 980, but we need the minus sign before 980. So that is why we will use the plus minus button. Now, what is this minus 980? We have to tell the calculator it is the present value. So then press PV. So in the screen, you will see PV is equal to minus 980. Next, we are going to enter 60. And this 60 is your PMT, the periodic interest that you are going to receive. How did we get that 60? It is 6% multiplied by 1000. And at last, we will enter 1000 and tell the calculator that it is the future value. We have to find what is the I/Y. For that, we are going to press compute and then press I/Y. And you will get the answer. I/Y is equal to 6.481023. So this is your answer. This is the return that you are generating if you are buying this bond today for 980 and holding it for the entire 5 years, and you are getting regular periodic coupons. So this I/Y is your yield to maturity, or the total return you are generating if you're buying the bond today and holding it till maturity. Now, what is the conclusion that we can derive? Note, when the bond is purchased at a discount, the I/Y or the YTM is greater than the coupon rate. Our coupon rate is 6%, but the return that we are generating from the investment is more than 6. It is 6.48. Today you are buying the bond for 980, but you are getting back 1000. So that is one of the reasons why the I/Y is greater than the coupon rate, and the return you are generating is 6.48, which is greater than 6. Let's see another question. Now, MNO Limited issues bonds with a face value of $1,000, 10-year maturity, and 7.5% coupon rate, which is paid annually. You buy this bond today from the company for $1,000 only. So that means this is a bond which is trading at par because the face value is equal to the present value. So let's calculate the return over here. So as you can see, I have written down the variables. N is equal to 10 because it's a 10-year bond. The present value is minus 1000 because we are buying the bond from the company today for $1,000. The PMT that you are receiving, or the interest that you are going to receive, is 7.5%, which is 0.075, multiplied by 1000, which is equal to $75. The future value is going to be 1000. We have to calculate the return. So I'll press 10, then I'll press N. I'll press 1000. Always remember to put the plus minus sign. This is your present value. Then I press 75. This is my PMT. I'll press 1000. This is my future value. And then CPT I/Y. So over here, your YTM, or interest or yield, is coming as 7.5%. So as you can conclude, if the bond is purchased at par, that means $1,000 bond, you are buying it today for $1,000 only, then the YTM is equal to the coupon rate of 7.5%. So YTM 7.5%, coupon is also 7.5%. Both of them are equal when you are buying the bond from the company at par. Let's see one more question. So Sunbeam Limited is issuing bonds with a face value of $5,000, 25-year maturity, and 9% coupon rate. This is paid annually. You buy the bonds from the company today for 5,100. That means you are buying the bond at a premium. So as usual, I have written down the values. N is equal to 25. PV is equal to minus 5,100. PMT is 9% multiplied by 5,000, which is 450. The future value is going to be 5,000, and then we calculate what is the YT. So first I'll press 25, and this is my N. 5,100. I'll put a minus sign, and this is my present value. 450 is my PMT. 5,000 is my future value. Compute I/Y, and the answer is 8.79%. So as you can see, If the bond is purchased at a premium, then the YTM is less than the coupon rate. The return you're generating is 8.79, but your coupon rate is 9%. So one of the reasons behind this is you're buying the bond today for 5,100, but you're getting back only 5,000. So you're kind of making a loss upon redemption. So that is why your return is less than the coupon rate. Let's solve another question. An investor buys a bond with a face value of $1,000. It's a 7-year maturity having a coupon rate of 8% paid annually. The YTM quoted for the bond is 9%. So in this example, the YTM is given, but we have to calculate the present value of the bond. So that is a variable which is missing. So let's write down all the values that we know. N is 7. PMT is, it's an 8% coupon paying bond. So 0.08 multiplied by $1,000, which is 80. Future value is 1,000. The YTM or the I/Y is given as 9%. So we are going to enter it as 9. So don't use the percentage sign, enter the values as it is when you are entering the YTM. And then we have to calculate what is the present value. Let's see. Now, before we calculate, I want you to do a mental calculation. The coupon rate is 8%, but the YTM is 9. So coupon rate is less than the YTM. So what do you think? Will the bond will be trading at par, premium or discount? Write down your answer, and once we do the calculation, check if you have got it right. So I'll press 7 and then I'll press N. 80 is your PMT. 1000 is your FE. 9 is your I/Y. Now, as you can see in this question, the order is not important. So I've entered the values randomly. And then at last, compute. And we are trying to find the present value. So the present value is minus 949.67. So yeah, whoever had written that the bond will be trading at discount, probably your answer is right. So present value is 949.67. The future value is 1000. The bond is trading at a discount. And if you buy a bond which is trading at discount, your YTM will obviously be greater than the coupon rate. 9% return is greater than the coupon rate of 8%. So out of these 5 values, if 4 values are given, you will be easily able to find out which one is the missing one. So let's go to the next level. Now, Rain Limited issues bonds. The face value is 1000. It's a 5-year maturity and a 9% coupon rate is paid semi-annually. So we are moving on from annual coupon paying bonds to now semi-annual coupon paying bonds. Semi-annual means once every 6 months. You buy the bond from the company today for $1,050. So this bond is trading at a premium. Now over here, we are going to learn a new thing which is known as a frequency. Now frequency of the coupon payment. If it's an annual coupon paying bond, you are going to get coupon once every year. If it's a semi-annual coupon paying bond, you are going to get coupons every 6 months. So in a year, you are going to get 2 coupon payments. And this is very common when it comes to bonds. Quarterly means you are going to get 4 coupons in a year. Monthly means the coupon or the interest will be paid on a monthly basis. That means there are going to be 12 coupons in a year. So the frequency is going to impact the N. It is going to impact the PMT, and it is also going to impact the I/Y. So we have to adjust the frequency when it comes to the N, the PMT, and the I/Y. Let's see how to do that. So first is N. This is a 5-year coupon paying bond, and every year you are going to get 2 coupon payments because it's a semi-annual coupon paying bond. So 5 multiplied by 2, N is going to be 10, as you will now receive 10 coupon payments. Present value, it is not going to be impacted by the frequency. It is going to be minus 1050. The PMT, the 9% coupon rate, which is given over here, this is 9% per annum. Because it's a semi-annual coupon paying bond, the annual coupon of 90 is going to be split into 2 and it is going to be given to you every 6 months. So that means you will get 45 after 6 months and then 45 after the next 6 months. Total in a year, you are going to get 90 anyways. The coupon rate is always quoted on an annual terms, even though in the question it is not mentioned as 9% per annum. it is by default assumed that the coupon rate given is on a per annum basis. So the 9% given to you in the question is actually 9% per annum. So PMT is 9%, 0.09. This is going to be split into 2. So we are going to divide it by 2, then multiply it with the face value of 1000. The answer is going to be 45. Future value is not impacted. It is going to be 1000. So let's do the calculation and check what is the answer. So first I'll press 10 and this is my N. 1050 is going to be my present value. Always remember to put the minus sign. 45 is going to be my PMT. 1000 is going to be my future value. Compute I/Y. The I/Y that I'm getting is 3.887. Now remember, we have written that the frequency is going to impact the N, the PMT and the I/Y. So we have to adjust the frequency over here. The return or the YTM you're seeing on the screen, 3.887, this is the return which is quoted on a 6-monthly basis. Because we have adjusted the N and we have adjusted the PMT, the answer of I by Y is also on a 6-monthly basis. But the rate in finance is always quoted on a per annum basis. So what we have to do is, because it's a 6-monthly return, your final answer, you just have to multiply this with 2. So multiply by 2 and you are getting the answer as 7.774016. So this is a small adjustment that you have to make if the frequency is anything different than 1. So over here the frequency is 2. So your final I/Y, you have to multiply that with 2. Now this 7.77, this YTM is also quoted on a per annum basis. So question coupon rate per annum basis, answer YTM also on a per annum basis. So remember this, you have to multiply the interest or yield with the frequency. So whatever answer you get, multiply that with 2. So it's a very important point. The above answer for I or Y is the return generated on a semi-annual basis. Even the I or Y is quoted in an annual terms. So we have to multiply the above answer with the frequency. Let's see the next question. So Rain Limited issues bonds, face value is 1000. It's a 5-year maturity. 9% coupon rate is paid quarterly. That means 4 times in a year. You buy the bond from the company today for 1050. So frequency is quarterly, which is equal to 4. And as said before, frequency will impact the N, the PMT as well as the I or Y. So N is going to be 5-year bond multiplied by 4 times coupon is paid in a year. So it is going to be 20. Present value is not impacted. The PMT is going to be 9%, 0.09 divided by 4 multiplied by 1000, which is 22.5. The future value is going to be 1000. We'll calculate the I/Y and remember to multiply it with the frequency. So whatever answer we get, we are going to multiply that with 4. So let's do this. We'll press 20. This is my N. 1050 minus, this is my PV. 22.5, this is my PMT. 1000 is my future value. CPT, I/Y. You're getting the answer 1.9458. Multiply this with 4 equal to, and the answer is 7.78%. So the YTM for this particular question is 7.78. Now let's try a different question. An investor seeks to buy a bond which is issued by JK Limited, having a face value of $1000, 5-year maturity, 8% coupon rate, which is paid quarterly. It is quoting at a YTM of 6%. So in this question, we have to calculate the price at which the investor will be able to buy the bond today. So they have not given us the present value. So frequency is 4 and it is going to impact the N, the PMT and the I/Y. So N is going to be 5 multiplied by 4, 20. I/Y. So I/Y in this question, they have given you, it is quoting at a YTM of 6%. This is 6% per annum. So over here, because they have given us the answer on a per annum basis, we have to convert it into a quarterly basis. So that is why we are going to divide it by 4. In this question, they have given you the YTM, it is 6% per annum. Even though per annum is not written, by default, it is assumed that it is an annual rate. So 6% also has to be adjusted. We are going to divide it by 4 and we are going to take it as 1.5. So return also has to be converted into a quarterly basis. The PMT is 8% divided by frequency 4 multiplied by 1000. It is coming as 20. Future value is 1000 and then we'll be able to calculate the PV. So let us press 20. This is your N. 1.5. This is your I/Y. It is the rate. The rate has to be converted into a quarterly basis because N is also the number of quarters. The PMT is also converted into the payment that you are receiving on a quarterly basis. So even the I/Y should be converted into a quarterly rate. Then I press 20. This is my PMT. 1000 is my FV, CPT and PV. Now PV is not adjusted. So the present value is going to be 1085.843194. So the investor will be able to buy this bond today for 1085 approximately. The calculator is also giving you the present value in a minus sign. That means this is the amount that you have to pay. So that's it from my side in this particular session. You can rewatch the video again and be very comfortable in solving the questions using this calculator. We'll be using this in the classroom. Now, when we have the session, I'll start explaining why the bond is issued at par, why it is issued at premium, why it is issued at a discount, and then we'll do some more calculations. I'll give you some more examples for homework. Till that time, be very, very comfortable in understanding the steps on how to solve different type of questions. Watch the video again and again till you are able to understand this.